Hi, everybody. Welcome to the Patti Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. Joining me today is Bill Cass. Bill is the Director of Wealth Management for Putnam Investments. Bill and I were having a fascinating conversation, but we were talking about President Biden's tax proposal. And Bill brought up a few things that I thought would be really important to share with all of you, because there's a lot of misinformation, a lot of rumors in terms of what's actually in this proposal. And it's really important that you know what is and isn't there to do your planning appropriately. So, Bill, thank you so much for joining us today. Welcome to the show.
Patti, thanks so much. I'm really excited. And again, thanks for having me on.
You got it. Absolutely. No, thank you, because, wow, that conversation we had was fascinating. So here's a question for you. When we were talking, this proposal is very different than what Biden ran his campaign on. What's actually in it versus what did he talk about in his campaign?
Sure. And I think, Patti, the proposal we're talking about, just so everybody's clear, is the American Families Plan. This was the latest large proposal coming out of the White House. So yeah, I guess the good news, Patti, is it wasn't as onerous or as negative as some of the tax provisions that were being discussed during the campaign season. So I guess that's the good news, right? For example, there was a lot of talk that taxes were going to go up for people with over $400,000 in income. And that wasn't clear on whether that was individuals or married couples, but that was sort of the threshold. There was talk about the state law changes to the gift and estate tax, and then there was actually some talk about increased payroll taxes, at least for some higher income folks. And at this point, now this is subject to change, but at this point, none of those things happened. So what they did, Patti, in terms of the income tax increases, they took a look at the top tax bracket, which is 37%, and that kicks in at about $525,000 for individuals and $625,000 for couples. And what they're proposing is reverting back to the rate that was in place before the 2017 tax law. So going from a 37% tax rate at the top end to 39.6%. So again, they talked about a $400,000 floor, and we just didn't see that. And again, at this point, they've taken the estate and gift tax changes off the table in terms of lowering what we call the annual exclusion amount, the amount you can either gift while you're living or leave pass in terms of property at death without being subject to federal gift and state taxes.
Okay, so that is a big deal. So let's kind of break this down a little bit because there's a lot there. First of all, on the increase in the rate, what I think is really important that everybody hear in terms of what you said was that right now that top rate doesn't hit, let's say, joint filers until they're earning $625,000. So it's just on the excess over that amount.
Correct.
What they're going to do is they're going to flatten that bracket, if you will. So from $400,000 and above, that's when you're getting hit with that 39.6%. So it's not just the extra 2.6% over and above incomes of $625,000. They're adding that extra $225,000 and hitting that as well, right?
No, not that is what was sort of proposed during the campaign, but that's not exactly what we saw happen. So if you look at the tax brackets today, really all they're doing is changing the 37% bracket to 39.6. That's all that's been proposed at this point. So
well, you know what?
None of the other brackets are changing. There's a 35% bracket and a 32% bracket and so on and so forth. None of the other brackets are changing. So I guess the good news is if I was a married couple, making maybe a little bit more than $400,000, unless we have income above actually $628,000, this proposal as it stands now would not affect me.
Okay, there you have it right there. Here I am, a certified financial planner. I am going nuts reading absolutely everything that I can about this new tax proposal, and I read differently. So there you hear it from the expert, Bill Cass. So for those of you who are listening, keep listening, because there are additional things that are out there that are just not true, at least in this proposal.
Patti, if I could say, the ultimate caveat when we're talking about taxes, subject to change. And of course, as we know, permanent tax law is an oxymoron. It doesn't exist. It's always fluid in some respect or another. So we could see changes that change that tax structure. But this is where we stand. What we know right now, from the proposal that was introduced by the Biden administration.
Okay. So the other thing that you brought to light was all of the draconian changes in estate tax law, reducing the amount that we can leave to anyone or the next generation, leaving that dollar amount or reducing that dollar amount from $11,700,000 down to $3.5 million. And on top of that, changing the amount that you can gift during your lifetime from that same number, $11.7 million, down to $1 million per person. That's it. That's all you can gift over and above, that $15,000 number. That is not in this proposal. I'm just kind of curious. Can you explain to our listeners and people watching today, why did they remove that? Because that feels like it kind of goes along with, we're gonna have the wealthy pay their fair share. How come they removed that part?
Right. It's certainly a policy objective of the Democratic caucus and the Democratic leadership. I think a couple things. First of all, I was pretty skeptical that we would see a proposal bringing it down to $3.5 million on the estate, the lifetime estate exclusion, and $1 million on the gift. In my mind, I thought maybe a floor was going back to the numbers in place prior to the 2017 tax law changes, which would have been, let's call it $5.5 or $6 million, maybe a little bit more if you take into impact inflation adjustments. So I was skeptical that we were going to go down as low as $3.5 million. That's not, I've been wrong before. I'll be wrong again. But what we're hearing from some of our key contacts in Washington was that they looked at it and they said, do we want to fight this political battle? And I mean we, meaning the Democratic leadership and their caucus. Do we want to fight this political battle of addressing the estate tax where, we might not have full support just amongst the Democrats in the Senate, for example. If you look at it, the numbers are slated to revert back to the pre-2017 numbers anyways after 2025. So I think from a political standpoint, they looked at it and said, okay, what's the cost benefit of this? The numbers are going to change anyways. So why are we going to expend political capital potentially to try to go in that direction? I think that's where it kind of, where everything kind of shook out.
And it's interesting. I think that it's very important that you and I kind of pause here for a moment and recognize that whether it be Democrat or Republicans, et cetera, what is the goal here? The goal here is to do some things with our nation that kind of need to be done, right? It is, the roads, the bridges, the infrastructure, the electric grid. These things really do need to be fixed. I got to tell you guys, 2 weeks ago, Bill, I was driving to work and I hit a pothole and my tire blew, right? And I'm thinking, gosh, will they fix these darn roads, for crying out loud? So there are a lot of things that do need to be done to make our country safer. The supply chain, what happened with pandemic, we couldn't get cotton swabs and things of that nature. So those things really do need to be changed. That's on the one hand. On the other hand, I'm also reminded of something that Winston Churchill said. He said, "We contend that for a nation to tax itself into prosperity is like a man standing in a bucket trying to lift himself out by the handle." Like, that doesn't really make sense. If I may say, and again, this is the other side of the argument. I'm not saying one is right or the other one is right. We are the wealthiest nation in the world. We have trillions. Is it 200 trillion? Is it 300 trillion of net worth in this nation? Yes, we have rising debt, yet we are still the wealthiest nation in the world. Does it make sense for the government to tax the wealthy, tax our citizens to this extent? So I'm just kind of throwing that out there. How do we solve these problems that really do need to be solved in a logical way that's fair for everybody? So,
and Patti, when back in the dark ages, decades ago, when I was a freshman in college, my economics professor said there's no such thing as a free lunch, right?
Yeah.
So it's great to have these spending priorities, and obviously there's a lot of infrastructure needs, but there's other spending priorities around education, health care, and paid family leave, which are all very positive things, but there has to be some revenue on the other side to pay for it. So I almost look at it, I look at the big picture, right? And I think anecdotally, I look at it, it's almost like, Patti, have you been to one of those diners that has like a million things on the menu?
Yeah.
It's got this huge menu, right? Okay,
yeah.
They serve breakfast, 24/7, right? Well, I think of that in terms of tax and spending policy. On one side, you have all these spending items, and they all cost something, and they're all ranked, and they all have dollar figures associated with it. And the lawmakers, at least their staff members, they have access to this information. And on the other side is this menu of items, of tax items, and how much revenue, presumably, those are going to bring in. So it's all about looking at these menu items and saying, okay, I'm going to pick, number 1, number 4, number 7, and number 10 on the spending side, and then here are all the ones I want to pick on the tax side. And then, so why I highlight this, because I think it's going to be a long, drawn-out process, this tax, as we get into the real tax writing work at the committee level in Congress. And that's going to be in the House, it's going to be in the Ways and Means Committee. In the Senate, it'll be the Senate Finance Committee. So I think, for some people that are expecting a lot of clarity this summer, I think this thing's going to drag out to, the fall and maybe even right to the end of the year. That's my personal opinion anyways.
Okay, so here's the question that everybody's asking us. Do you think they're going to make it retroactive?
I get that question a lot, both from professionals like yourself and your clients. That's certainly not our base case. The last time we saw a retroactive tax increase was during the Clinton administration. And what happened sometime in the middle of the year, they made a tweak in the estate tax, the actual rate. The rate, I think, went up from like 40% to 45% or something along those lines. And that was effective the date of that proposal mid-year. But we have not seen, since then we've not seen any retroactive tax increases. We've seen retroactive tax decreases, net positive to the taxpayer. We saw this in the early 2000s in the Bush administration where people got refunds. But it's certainly not my base case. The one question I'm getting, we talked about income taxes, right, Patti? But we haven't talked about capital gains taxes, right? And that's also on the docket, right?
All
so could they?
Yeah, let's explain that. Yeah, and talk a little bit about that.
Let me take you through the proposal, and then maybe what I'll do is sort of give you my 2 cents on what I think is more likely in terms of capital gains. So the proposal outlined by the White House as part of this American Families Plan would say, okay, if you're making more than $1 million, if you're at that level, whatever capital gains and actual dividends apply as well, capital gains and qualified dividends, we're going to tax that as ordinary income. So the same as your wages, the same as interest from a CD at the bank or anything. So that would be as high as 43.4%. So that gets people's attention. Mm-hmm. When you're talking today, the most you'll pay on a capital gain, a long-term capital gain, is 23.8%. Now you're telling me for some people, and granted, it's not a lot of people, it's at a very high income level, but going to 43.4% is a pretty stark increase.
It sure is.
I don't think that's going to happen. I do not believe they have 50 votes in the Senate to pass that. Remember, if they're going to pass tax legislation, tax increases, they're going to, they can do that with only 50 votes in the Senate if they use the budget reconciliation process. But I don't think they have the 50 votes to do that. Senator Menendez from New Jersey, Senator Warner from Virginia, Senator Manchin from West Virginia, they have indicated that they're not on board with that stark an increase. But could we see capital gains going from a max of, let's call it 23.8% for some taxpayers to 25 or 28%? I think that would be a more likely scenario in my estimation.
Yes, that's exactly what I've heard. Do you think that they would apply that lower rate to a broader base, maybe cut the $1 million and above down to $750 and above, just to kind of make up that revenue? Is that a possibility?
It is a possibility because I go back to the diner menu, right?
Yeah.
Right, Patty? And then they start tweaking it. And so as we progress further on in this process, and people start getting, the lawmakers start sort of prioritizing what they want to do, and you might need an extra, $20 billion worth of revenue. Okay, how are we going to get that $20 billion worth of revenue to offset some other additional costs? Well, okay, what if we tweak this? What if we change this? What if we turn the dial on this particular provision? So I think when you get to that fine-tuning, that's where you might see some of the stuff. But I don't think we're going to be looking at a 43.4% rate at the top end for long-term capital gains.
Okay. One thing that I was surprised at, and you can verify this or not, the 1031 exchanges for real estate. They're talking about getting rid of that for people who want to, buy up and defer the capital gains on their properties, rental properties, things of that nature. That was a surprise to me. I did not realize that was something that they were looking at.
Yeah, well, they did scale the 2017 tax law scaled back 1031 exchanges in terms of not in terms of real estate, but with like equipment. So in the tax code previously, you could apply that same option if you were, heavy construction equipment and you were exchanging it for some other type of equipment. You could defer any type of capital gains. I don't know how much that was used, frankly, but they did get rid of that. But they didn't touch real estate. And now, with real estate, if your gain is over $500,000, that's going to change the calculus for some folks that own rental properties that, as you know, and I'm sure some of your clients have benefited from tax deferral.
Oh,
it's
yeah.
a way to maybe create some liquidity in that market. Mm-hmm. If you don't have to, you're not facing taxes, you can just exchange out it from one property to the next. So you're right, Patty. I'm interested to see how that's going to play out. But certainly the real estate lobby is going to be working hard in Capitol Hill to educate lawmakers on that, and they're going to make their case, right? They're going to make their case that this is going to have detrimental effects in that are going to have a broader impact. We'll see how it plays out, obviously.
It's interesting because as this information gets out, it'll be fascinating to watch whether or not it accelerates this real estate boom that we're seeing, houses being sold for, significantly above asking price. And if people think that 1031 exchange is going to be repealed, that you're not going to be able to do it, I wonder if this is the year that people go and buy up to the next property, to the next level on, second homes, vacation homes, things of that nature.
Right, or commercial real estate. If I own a part of a strip mall, or what we call them in Boston here, in the Boston suburbs, these triple deckers, right?
Oh, yeah.
These rental properties that are sort of ubiquitous to the Boston area. Certainly, it's gonna change some thinking around there. I think also, with business owners. If I'm a business owner and I've been in the process of sort of planning out my exit strategy, I think one of the things I'd be thinking about, if I think the capital gains rate is going to go up a little bit, maybe that makes the case for doing more of an installment sale and spreading that gain over a number of years. So it's going to be interesting to see how it plays out. Now the planning is really difficult because you want to be cognizant of these changes, but you have to understand that we don't know what's going to happen or if anything's going to happen at all.
Mm-hmm.
So that's That's the difficult part about planning for this stuff.
It is so tough, Bill, because the fact of the matter is, no matter what we do, there are unintended consequences to everything,
Correct.
right? So let's say that somebody's, at that high income level. And, we've had these phone calls already with people. I got a software program to help us calculate. Does it make sense to prepay the capital gains? Let's just sell everything, pay the 23.8%, increase reset the cost basis and move on from there. But then this way, you've cut the tax bill significantly. What's the time value of that tax money not remaining invested, and how many years does it take to make up that difference? So it's really interesting. I would never want to prepay capital gains taxes. If you don't need the money, just leave it there. And yet those people are like, well, I don't want to be paying 43% on my gains. And I understand that part too. So
and I go back. I just think that 43%. That's not anything can happen, right? Within reason, but I do think that's really an outlier. I go back to, Pat, I'm sure you remember, as we got to the end of 2012, we had this fiscal cliff and no one knew what was going to happen in terms of the tax structure at the time because there were expiring tax revisions, including the estate tax.
Yep.
So there were folks, I've talked to advisors like yourself that had clients that gifted aggressively at the end of 2012 thinking the estate and gift tax numbers were going to change for the negative beginning in 2013, and those numbers didn't change. And eventually they even got better, through the 2017 tax law. So there's people that gifted aggressively back in 2012 that are sitting here 8-9 years later thinking, oh, geez, I shouldn't have done that.
Right.
That was a mistake. So it's there's no easy answers is what I'm trying to say.
Bill, to that point, I think the key here with all of this is to run the numbers. If you do option 1 versus option 2, what could it look like if the laws stay exactly as they are today versus if they changed? And would there or could there ever be that point in time where you look back and say, gee, I wish I hadn't? Because that's not fun. That is not a good thing. And ultimately, the real litmus test for all of that is you just want to make sure that you're going to be financially secure for the rest of your life, no matter what, right?
Right.
That is first and foremost with all of these strategies. I think that speaking of a dramatic change, getting back to the estate law, is the repeal of this loophole that we have currently. I almost hate to call it a loophole because it's so important for so many families, but the step up in cost basis rule.
And you're right. Use an interesting point that you say a loophole, and it's really, I don't see it as a loophole because you have potentially folks that you owe and pay federal estate tax, but then you're also going to tax them additionally on the gain in those assets as well. So there's a little bit of science behind the structure in terms of trying to avoid, at least for some people, double taxation.
Yeah, that is an example of capital punishment by confiscation. Literally, Bill. Am I wrong? It's like, it could add up to 70% of the underlying assets goes to the government in one tax or another. So that is something that could be a little scary. It's also, yes, there is on the first $1 million of gain, the proposal currently says on the first $1 million, we're not going to tax that, but anything
Correct.
on top of it, well, it doesn't take long for, people's gains over their lifetime to exceed $1 million, especially when you consider real estate and, assets that they may have held and decided I'm going to just keep on holding this and use my retirement account instead because at least it gets that step up in cost basis and the kids don't have to pay a tax on the gain. So it is, and it's really devastating. It could be devastating for our business owners, people who own businesses. You got a business. For a lot of people, that is the lion's share of their net worth. So they've got a business. They've put everything into it, their sweat equity, as well as reinvesting into the business to grow it. And then they die, and they might have a little bit of liquidity in a 401k, but if the business is subject to a significant tax, what do you think the business owner or their family has to do? They have to sell the business. Well, excuse me, but they're not going to get top dollar. That's where the word fire sale came from, because everybody knows that the business is being sold because the family has to sell it because they have to pay the tax within 9 months. So that could be
Patti, I'll give you another example too. And probably in your neck of the woods, you think about folks that have families that have places maybe on the Jersey Shore, up here in my neck of the woods outside of Boston, in Cape Cod, or up in New Hampshire, Maine. And we're talking about families that aren't extremely wealthy, but might have that multi-generational family home. It's been in the family for 50 or 100 years. Who knows what the cost basis is, right?
Right.
And so that could be real problematic to folks in that type of scenario. If you're going to tell me at the death of whoever owns that piece of real estate now, it's basically there's going to be a capital gain realization at death, which that's the bad news. The good news, Patti, is again, I don't have a crystal ball, but I'm still pretty skeptical on this effort to repeal stepped up cost basis at death. There's a lot of there's growing movement among some lawmakers, especially in the rural areas. You're talking about family farms that have come out against this, and certainly there's going to have to be carve outs and exclusions. But the more complicated it gets, the more, in terms of carve outs and different exemptions, the more complicated it's going to be for the IRS to try to enforce this. So I think this is sort of the type of tax provision that is going to be tough to enforce. It's going to be complicated, and I'm not sure they're going to get enough support within the Senate to have it proceed as it's currently written.
You know, Bill, as you were talking, I was thinking about this. Maybe the timing isn't right also, because this law that requires mutual fund companies and brokerage houses to keep track of cost basis, that was passed in 2012. There are a lot of people, there are a lot of investments out there that were purchased way before that, and people don't have a clue what the cost basis is. So how are they going to, account for that properly? And it's one person's, opinion, or, how are they going to prove it one way or the other? But the further out we go, the more data they're going to have to be able to enforce something like that. So I think that as you were talking, I'm thinking, you know what? They'll probably throw it, throw everything up against the wall, that included, recognizing that probably won't go through. I think that everybody listening today might want to expect that could come back in the future. And to your point, I think that there could be some carve-outs. That would be the right thing to do, because this is America, and what do we do without our businesses? That's
right. How do you, valuing closely held family businesses, Patti? There's as much art to it as science, really, in a lot of cases. So I think it would be, and not to say that it couldn't happen, because that's the Canadian system. Mm. So in Canada, they do tax with some limitations and some exemptions, but they do tax, once it goes to someone other than the spouse, they do tax capital gain property at death. Now, they don't have an estate tax in Canada, so they sort of pick one or the other. And as if you remember, that quirk in the tax code for people who passed away in 2010, technically there was no estate tax, federal estate tax, in 2010. People could opt out of paying the federal estate tax, but in lieu of that, they did not get a step up in cost basis. So it was one or the other.
But what was interesting about that's different, and correct me if I'm wrong on this, in that one they didn't get the step up in cost basis. However, it wasn't that you had to recognize the gain at death and pay the tax. Is that right?
That's absolutely. It was what we call carryover basis. So the same principle that would apply if I gifted you appreciated stock, Patti, you would inherit my original cost basis. If it's a gift while we're living, you're right, it was carryover basis. But lawmakers look at taxing those gains at death, and they look at go back to the diner menu, right? That brings in a heck of a lot more money from a revenue perspective than it does if you say, okay, you're not going to get step up. We're not going to tax you at death, but you're not going to get step up. It's just going to carry over to your heirs, and when and if your heirs end up selling that property, they're going to have to pay that capital gain. But you're absolutely right.
It is really, really interesting. All right, so we've talked about the problems. Okay, now let's focus on the solutions, especially given the fact that the estate tax changes are not in this bill. We were talking last week. I'm getting a lot of phone calls about this. People are setting up these spousal lifetime access trusts with the thought that, I want to take advantage of the 11.7 while we still have it, because if they take it away, if I gift 11.7 to my spouse, put it into trust for my spouse, at least, with the end beneficiaries being the kids or someone else, at least I've used up the full 11.7 before we take it away. The downside to that potential tool is that when you gift during your lifetime, just as Bill just said, there is no step up in cost basis. So, yes, you're preserving that unified credit exemption, but somebody's going to pay the capital gains tax in the future. So, there is no free lunch as it relates to this stuff, and you got to understand, and it is important to understand the unintended consequences and make sure that this is a problem that actually needs solving, right?
Right.
We don't have a change in the law yet.
It's not a problem, what's the saying? It's not a problem seeking a solution, right?
Right, exactly.
A solution seeking a problem.
Right.
The other way around. You're right. And, I think it is, for some higher net worth families, I think it certainly is prudent to have these conversations with their estate planning professional to look at, okay, there is a risk out there. Well, right now, when the 2017 law expires, we'll have a change in the numbers. Now, we could see a whole new administration before then, and we could see the numbers carry over. We could see the numbers change for the better. Who knows what's going to happen? But maybe you, Patty, maybe you hedge your bets a little bit, right? Maybe you you're not super aggressive with, for example, the spousal lifetime access trust strategy and gifting to the maximum at this point. Maybe you're gifting below that, and you're sort of hedging your bets a little bit. Every situation, obviously, is going to be a little bit different.
And I think your point is well taken. Talk to your professional advisors. Sit down with your estate planning attorney. Maybe have a strategy in place that you can pull the trigger quickly if it's something that needs to be executed. So you kind of know what your options are and the pros and cons. That makes a lot of sense. But again, be careful about what some of the unintended consequences could be. So
absolutely, and then on individuals, Patty, I think this is more broad to a wider swath of investors out there. It's just, how can I hedge income tax risk? And one of the best ways to do that is with Roth accounts, and whether it's funding Roth accounts or using Roth conversions. And I'm certainly not a fan of being super aggressive and going all in on Roth and prepaying, like you said, prepaying taxes today and making a huge bet. But I think I'm in favor of gradually over time trying to build some diversification tax-wise. I'll use myself as an example, Patty. I've been with Putnam 30 years now, and one of the issues that I face is that I've been in the Putnam 401k for these 30 years and funding it primarily with pre-tax accounts, which has worked out, favorably. But when I retire, I'm very much overweight pre-tax retirement. So every dollar I take out is going to be subject to ordinary income taxes. So to what extent people can at least build a little bit of diversification using Roth accounts, it gives them more flexibility in retirement to better manage their tax bill. If they're in a high tax bracket for whatever reason, 1 year in retirement, maybe they need income. Maybe they take some income out of the Roth, which is, if they follow the right rules, is tax-free. So it's not exacerbating a bad tax problem further.
And I think that it's not just the tax problem, it's also the cost of Medicare, Part B. You can get hit with that IRMA, the penalty tax. You have to pay more for IRMA. It could bring more Social Security. You know, most people are probably going to have 85% of their Social Security included in taxable income. And yet there could be those years between retirement and age 72 where none of it is taxable, or maybe just, 50% of it is included as income. So there's a domino effect in every decision. Just know what those effects are in your personal situation. So,
correct. And don't forget those HSAs too,
Yeah.
health savings accounts.
Yeah.
Those, and to avoid, if you're funding an HSA, try to avoid tapping into that if possible. And if you're able to let that grow and use that in retirement, it's going in, it's tax favored on the way in, potentially could grow tax favored, and it's tax free on the way out if it's for qualified expenses. So
it's the only thing out there that is this is truly the whole home run is the
Right.
HSA, because it saves tax going in. You're not paying taxes on it. It grows tax deferred, and you're not paying tax on any of the gain as long as you follow the rules. So home run right there. Great point. So let's kind of pull this together. Okay, so we kind of know what's there. Granted, the proposal is not as draconian as we originally thought. We're a long way to knowing what that bill is really going to say, right? What do you think would be most likely? Just out of curiosity.
I think it's most likely, we didn't talk about the corporate tax side. I know we're not going to really get in that, but I think I could see a corporate tax rate increase from 21% to 25%. Not as proposed 28%. So that's going to provide them with some revenue there to offset at least some of what they want to do on the spending side, whether it be infrastructure or healthcare, childcare, education support, those types of items. On the individual side, I think, for me, the most likely movement would be, the current 37% tax bracket where that falls, and that's at about $523,000 for individuals and above $628,000 for couples. I think that goes back to 39.6%. I do think they have enough votes within the Democratic caucus in the Senate to do that. So those are the two most likely items. I wouldn't be surprised if we saw that long-term capital gains rate and qualified dividend rate inch up a little bit from 23.8%, maybe to 25 or 28%. But I just don't think they have enough votes to get to 43.4% for some people. And then less likely, call me a skeptic, I'm still a little bit skeptical on changes to step up and cost basis. A lot of moving parts, a lot of complexity, very difficult to enforce that type of provision. I could be way off there, Patty, and I've been wrong before, and I'll be wrong again. But as we stand right now, it's an important policy objective, but I think it's just the complexity of it makes me a bit of a skeptic.
Well, Bill, I can speak for myself and probably everybody listening to this podcast today or watching it. I hope you're not wrong. So let's do this. How about you and I do this? So we've heard it here first. It is, by the way, tax day, May 17th. We'll kind of lock and load. This is the day that Bill Cass said A, B, and C. Bill, would you like to come back? Would you come back maybe in the fall when we have a little bit more clarity? And let's kind of circle back and say, okay, this is what we thought. This is actually what's going through. And we can really summarize what our listeners and people watching really need to do at that point. We're going to have enough time, I think, before the end of the year, right?
I think so. I think it'd be sort of a fun exercise to say, hey, okay, this is what we were talking about back in tax day. And, let's say maybe it's in October, maybe November, even early December, whenever we have more clarity, it'd be sort of fun to see, well, geez, this was really a big surprise. We thought it would play out that way. And then once we have more clarity, there'll be more clarity around sort of the planning, the individual financial planning items. I think that's really the most important thing.
Okay, Bill Cass, it's a date. All right. So thank you so much.
I'm looking forward to it.
Oh, me too. And thank you so much for being here today. Thanks to all of you for listening. I hope this was helpful, clarifying a lot of things for you and for us in terms of what's actually in the proposal and what we need to do about it. So thank you for joining us today. If you have any questions, you need some clarifications, go onto our website at keyfinancialinc.com. Let us know what you think. Feel free to contact us. We'd love to hear from you. In the meantime, I hope you have a wonderful day. And I hope, by the way, you've already filed your taxes. So thanks again. Take care. Bye-bye.